All right,
Jerry?
Dale. Dale, I
All
made it
right.
in here.
All right. Yeah, I know you didn't want to, you refused to be promoted. We should we should always welcome promotion in our lives, don't you think?
Indeed, of course. I didn't see it. I just saw it now.
Oh,
So,
oh, okay. Well, it said you declined the promotion. I thought it was
oh
gonna.
no,
All right.
no, no.
Anyway, it's really good to hear your voice and see you,
Likewise.
Jerry. Great time of the year to start looking ahead. Let's see what you have going into year end, and looks like you prepared. Is this your website that you're showing right here? Okay.
Yes, this
All
is
right.
followthemoney.com/charts. So this is for
Okay.
our premium members here. But back behind this wall, we have tons of stuff, of course. But this is today. I thought we would just take a look at some charts,
Okay.
and then just kind of discuss some of the key markets, some of the major markets. But I'm happy to address any questions specifically you have. I'm
Okay.
very interested today in the dollar. I'm interested in gold. I'm interested in the NASDAQ. I'm interested in, of course, maybe Bitcoin as well. But we can talk about anything.
Okay.
Um, but a lot
Uh,
has
uh,
happened. Yeah, go ahead.
Everything you mentioned, you're probably bullish, correct?
Let's see. The dollar, not.
Oh,
Silver
that's right.
or gold, yes. NASDAQ,
Okay.
yes. And Bitcoin, yes. So everything but the dollar. In fact, the
Okay. Well,
last
when the dollar's bad, you could be bullish at everything, right?
That's exactly right. And in fact, that's part of the reason what's been driving this market higher is that dollar. And for those who are new out there listening, and maybe you're a new trader, and of course, I know you focus obviously on forex, so I'm not telling anybody anything they don't know. But I know your audience focuses upon that. But the thing to keep in mind is that that dollar really does have a great impact upon all assets that are denominated in it. So
Yes.
commodities,
Yeah.
or maybe stocks, even bonds and things like that. So they're all affected by it. And last time we talked, we were talking about this particular chart. Let me see if I can zoom in just a bit more. There we go. That's nice and big and pretty. Okay, so that particular chart here, we had said that it was very clear to us that the 106 to 108 level was going to
Yeah.
pose severe resistance. It was going to be very tough, and that we couldn't even imagine a catalyst short of inflation staying sticky for too long that would possibly push it up, albeit some other black swan that we couldn't envision. But we did see this historic rally, and I'm sure you know that, Dale, because from July, and July seems to be an interesting month for the dollar.
I called
Sometime
that bottom on Real Vision.
did you now? Okay, perfect.
Yeah,
Well,
that day.
it's funny because the like the Stansberries of the world and a lot of the newsletters that
Oh
are
yeah.
out there back in 2014, they called the death of the dollar July
Yeah.
2014, and
Yeah.
that was the mark of a huge uptrend, incredible uptrend.
Yeah.
Well, this rally in the dollar starting in July, we had, I think, I want to remember, if I remember correctly, it was 13 or 14 consecutive positive weeks. I think it was 13. And
Yeah.
going back in history, I couldn't find anything similar to it. So this was kind of a scary rally, even though it was fairly muted and it was still a lower high.
Yeah.
This was a
Halfway
very,
back. Yeah.
yeah, this was a very interesting rally. Well, anyway, it got up here to about 107, and this was it. I mean, this was the crunch time for us. And we said, look, 108's, we can't see how it gets above this. What's the catalyst? And there really wasn't one. It turned out that we
Yields
had
peaked.
yields peaked, and predominantly due to a couple of things, but especially the Treasury borrowing amount that came out at
Yeah.
was at the beginning of November or somewhere in there. Maybe it was October, but they had put one out. They had put out, the Treasury borrowing had put one out back at the beginning of July or around in July. And that drove the dollar higher, yields higher, because they were borrowing more than what was expected. They were borrowed like $1 trillion in Q3. But then when they got to Q4, they said, okay, our planned borrowing amount here at the U.S. Treasury for the next quarter is going to be $776 billion. Now, that's outrageous. But that was much better than what Wall Street had anticipated. They were expecting $850 billion. And so when the Treasury said, we're only going to borrow 776,
Yeah.
this was a kind of a deflator, if you will, for yields, and we've been seeing it work its magic. So just
Do
like
you like the bonds longer term?
I
Really,
think,
I mean, we haven't really retraced that much of the catastrophic decline. Do you like them?
If I were a bond investor, I would be buying here. I just don't tend to do bonds. I tend to even focus more on safer equities before bonds. But bonds, to me,
Okay.
two of my favorites right here would be, I've been telling our members, TLT, of course, the big
Yeah.
giant. And then
Yeah.
another one that I like, put out by Vanguard, is the Vanguard corporate long-term high quality
LQD.
no, it's VCLT.
Okay.
And I've used that as a cash fund for, off and on throughout the years. And of course, it got hit in 2022, but it looks really attractive as well. So those are two, that I would say would be interesting to me. And I think that we really have hit the bottom, so to speak, on all of this. A lot
Okay.
of this, Dale, you've been through this so many times. We talked about this before. A lot of this negative Nancy sentiment is caught up in two things, at least two things. Number one, we just suffered through 2022, and 2022 was a bruiser. I mean, going back and thinking about it, man, this was nuts. I mean, what we went through, and that people tend to get stuck in a moment. And so just like 2008, when we went through 2008, it was like a meat grinder. And people said, well, I can't go back up in 2009. It has to keep going down. I mean, look, where everybody's scared. Well, the market doesn't care. Market started
Yeah.
going back higher. And of course, there were catalysts for that. Well, here,
How do you overcome recency bias, Jerry, which a lot of people suffer from that syndrome?
just technical analysis and focusing upon
Yeah.
the chart. The chart has
There
saved
you
my
go.
hide so many times. I
I
just
knew
go.
you'd give that answer. So
Yeah, just
there you go. There's a little lesson for everyone when you may have a bias or a view,
yes, yes,
but check that narrative out with your price action.
absolutely. Trust the charts.
Yeah.
And the other thing is to keep in
They're
mind as
like your
well.
wife, right, Jerry? You have to trust them.
I don't. I don't know if I'll say that, but I
All
agree with
right.
the
Anyway,
sentiment.
well, you'll have to love them like your wife,
Gotta
your
love them. Gotta
charts.
love them. That's
All
right.
right. Anyway,
So,
okay.
so the first thing is that recency bias. So there is that fear of, okay, wow, we've been through this meat grinder. How can it end? How do we know it's over? And I'm not going to put my foot out into the water until I know it's absolutely positively safe. That tends to be a new all-time high. Guess what?
Yeah.
The Nasdaq 100, Dale, is
Did.
2 or 3% from a new all-time high.
Yeah.
The S&P 500 is trading like 5 or 6% from a new all-time high. Can you imagine the shock and awe that's going to come on when the average person sits down at the CBS Evening News and hears the S&P's at a new all-time high? They're going to be like, "What? I mean, how is that even possible? We've just heard
Yeah.
it's Armageddon. We've been
Yeah.
hearing that it's not safe to get back in the water. Now
Two
it's an all-time high.
wars.
2
Yeah.
wars? Okay.
Yeah.
So
Terrible
so so the,
bond
so the
market, everything. Yeah.
yes.
I think, you know, in a New York minute, everything can change.
That's it. And so the two major reasons why I think a lot of negativity still lingers is that recency bias, which probably I appreciate that phrase because that really is what it is. That composes a large part of it. The other part, I think Warren Buffett teaches us. For a long time, when I first got started in trading back in '96, one of the things that I kept falling for was I was kind of a political guy. And so when my guy would get into office, I would say, "Oh, great," and I would think, "Well, everything's going to be great now." It's idiotic thinking. And then when guy I didn't vote for got in, I would say, "Oh no, it's Armageddon. Everything's going to be destroyed. He's Godzilla." Okay, so that's another aspect of what's happening here is that there's a lot of people who think Trump is the savior and Trump is going to fix everything, and without him, the market has to go down, and that Biden is some sort of antichrist, and now that he's in office, he's out to destroy your wealth. Okay, well these work really well in newsletter headlines, and they really
Right.
work well
Clickbait.
for clickbait, but in reality, a lot of us still kind of cling to those kind of juvenile ideas because it's just kind of human nature, so politics plays a large part as well. I bring up Warren Buffett because he said something a long time ago. I didn't know he had said it. I started saying it, and then I heard him say it. I said, no, it has to be true now that I've heard him say it. And that is, don't trade or invest based around your politics, and I think a lot of what we've seen too has been fear or negative Nancy sentiment saying that, well, Biden can't do anything right. Biden's going to screw the pooch. Biden's going to destroy the wealth. Biden's going to destroy the dollar. And that's just a popular talking point on the right. And if you listen to that and you're an investor, well, it can affect you. So I would say the politics angle and the recency bias, I think, have prevented some people from participating in the rally. Now, there's been certain things that have done much better than others. For example, let me open up our Robinson report. This is a weekend report we put out for all of our members, and I'll come down to the returns, and you'll see here we track 10 major markets, many more, but just 10 major markets for the sake of brevity in our report. And Bitcoin year to date up 130%. Nice. I mean, that's just absolutely outrageous. And then you got Ethereum 75%, NASDAQ, Dale 47%. You could have thrown your money in the NASDAQ 100 at the beginning of the year and made 47%. The S&P 20%, gold 11%. I mean, the big laggards here year to date as of now have been China, silver and crude oil. And then also especially Russell 2000. Russell 2000 we think is probably due for a rally, but I'm kind of mixed on small caps anymore. It used to be that small caps really could outperform the large caps. Today it's kind of a winner take all mentality, and I think you got to be real selective in the small caps. But overall, I think that's another market that's probably going to see some nice rally next year. Also, these interest rate sensitive sectors, real estate, utilities, consumer staples, these are all nailed. I mean, these have all been really hit. Dividend aristocrats, I like that list right here. I think those are good ideas as we go forward for those with a long-term perspective. If you're trading, then you could probably build the case that, in the near term, some of these things are overshot. I mean, Bitcoin and Ethereum probably due for a pullback, maybe even a 10 to 20% pullback before they go higher. So if you're looking for, things that have overshot, maybe that. The NASDAQ 100, maybe not. We see more upside for the NASDAQ as we head into next year. So that's just a quick year to date.
Do you think it's all clear, even though you're looking for new highs, that the bull case is going to hold together through 24? Because I know some people that think there's going to be a couple of rough quarters in the market.
Sure. No, I do think the economy,
or third quarter.
Yes. The economy itself does appear to be slowing down. And even though we've had better than expected GDP reports, we're expecting a little bit of a slowdown in 2024, maybe even just grinding to a little bit of a halt briefly. Now,
soft landing.
I don't know about that. I do know
no landing.
Well, the thing that I'm concerned about is I'm seeing deflation show up in not food, but I'm seeing it show up in a lot of consumer goods, sporting goods, in a lot of the other areas, which is great in some ways because you want that. That's exactly what the Fed's been driving at, is to try to get the inflation to move the opposite direction. What do
you think of this, Jerry? We have deflation in things we own and inflation with things we use.
Perhaps. I would say that's probably true to a certain extent. But one of the reasons I think as we look forward, why we would say, well, how could you be bullish? What possibly could go right here? Well, one of the things that's interesting is the Investment Company Institute, which tracks tons and tons of financial institutions data, shows that there's currently about $5.7 trillion sitting in money market funds earning around 5% on the sidelines. That's between retail and institutional investors. Well, just over the last 30 to 60 days, QQQ, which we just talked about, right here, this particular chart, QQQ, which is just, again, so close to a new all-time high, reported its largest weekly inflow in history last week, or the week before, the last couple of weeks. So the largest weekly inflow in history is the week of November 13th. So QQQ, they get inflows, they get outflows all the time. They got the most inflows they've ever received in any single week this month. Okay, then we saw the corporate bond market, two bond indexes that reported their highest weekly inflows on record in the middle of November. When you add all that up, then you say, well, where's that money coming from? Well, then you go back to the ICI and you find out what the stuff they've been putting out, and it shows that in October, money market funds posted their first significant monthly outflow since interest rates started began rising. So here's the deal. You have people beginning to expect rate cuts. There's already 4 now expected. There were 3, now there's 4. So we're seeing a slight adjustment. And then on top of that, you have people who are earning 5% in money markets, and their buddies are earning 50% in the NASDAQ. Okay, you're earning 5% in the bond market or in the money market, and then your friend is earning 20% in the S&P. It would take you 4 years to get what your friend got with sitting in the S&P, just the boring old S&P. So he just quadrupled your 5% bragging rights on your money market. So there's a lot of people who are looking at this and saying, "Now wait a minute, 5% is good, but look at what's happening in this market, and rates are coming down."
In fact, 5%, if you're in money market, that goes away as rates decline, and the move would be to lock it in, which is what's happening by going for some duration. And it was such a massacre before this recent bond rally, Jerry, that I'm sure there was a lot of massive outflows of bonds over the last year. What if there's some reallocation to lock in these high yields? Could that cause a little less liquidity going into equities and shifting into bonds?
I guess so. That's a really good question. I presume it would. Yeah, I presume that it would. But when you think about that $5.7 trillion sitting on the sidelines between retail and institutional, you think, man, that's just a lot of money that's just sitting in cash. It's just sitting in cash. And so if we start getting a real move in the markets as rates come down, then you're just going to see people start to, and then you have so many things that you can really build the case they're beaten down. I mean, so not every stock is more part of the Magnificent Seven. Some companies are just trading at multi-year lows, and they're high quality. So they've just been neglected. People have been scared, and they've gone to cash. And so I think there'll be a lot of bargain hunting. There already is starting to see some bargain hunting, but I think we'll see a lot more as we head into the next year. We also have potential that Russia and the Ukraine war is nearing an end. We've been hearing that rumor for a while, but it seems to be gaining speed. We also have a truce in Israel and Hamas, is fragile truce. We'll see how long that lasts. We pray that for peace in that area.
Tell us about peace in Ukraine. What are you hearing?
Well, what we've been hearing is that Russia's Vladimir Putin is at a place where either A, due to his health, or B, due to just bad politics, he seems to be wanting to broker some sort of deal. We've been hearing that, though. I got to say, we've been hearing that for a while. It just seems like the last couple of months, those rumors seem to be getting a little more valid. And so I'm very hopeful that we're going to see an end to this at some point, soon. I'm as anti-war as they possibly get, and I certainly would love to see that war end. And of course, the one in Israel and Hamas. The problem is like whack-a-mole. You end these two wars, and then the military-industrial complex will start something else somewhere else. So it's a constant battle. But anyway, gold. I know there's probably some gold bugs out there. You know what? Me included, I do like gold for the long term. I think it's a great place for a small portion of your capital as insurance. Portfolio insurance is what I call it. Okay. I think it's a great idea. And we're getting ready to see, I think, a new all-time high. Why? Because of that dollar. Dale, that dollar comes down, gold's just going to touch $2,100 probably pretty soon.
Do you like the miners, Jerry? Gold miners, silver miners.
Yes and
cheap,
no,
man. They're very
cheap. Yes, I like them specifically for trading. I don't like to invest in miners. So I two different hats there: the investor, the trader hat. Yes, happy to trade mining stocks, but I wouldn't want to hold them for a long time. But with gold, it's different. I'll just sit there and hold the metal. Same thing with silver. I'll hold the metal.
I like that gold silver ratio chart. Maybe before you move on, tell us what it's saying to you.
Well, this just means that right now that the bias towards silver is still remains elevated. This little yellow line I don't really have marked, but this is kind of an important line in the sand. When we get below this line, it tends to be pretty heavy resistance. Yeah, exactly. We'll be leaning towards back to gold at that point. But so
you say at 50 you would go back to
gold.
You sell your silver and buy gold.
Exactly. And then when we get back up here, exactly. That's it.
Okay. Thank you, Jerry.
Oh, yeah, you bet. And then as far as the dollar goes, I mean, again, we've had lots of talk about the dollar. We've had lots of talk about how, it's going to go higher. We're down at 103 right now, nearly 103.02 this morning. VIX is at 1390. I mean, these are very, very low. Oh, in fact, we just crossed it. US dollar right now, I haven't seen this print until just now, 102.97. So we're at 102.97 right now live. This chart's a little dated, day or two. But anyway, so the dollar is now in 102 range. How about that? After coming up and hitting, 112, or it probably got a little bit higher than that, but about 112 or so last year. And notice this. What you see here is you see back in 1985, that was the Plaza Accord back then. People remember that. It got really high. That was the peak. And then you came down, and then you got another peak in the wake of September 2001, 120. Okay. And then we had this gargantuan inflation and COVID and all of this, and we came up to 112. So again, you can see that this is clearly a bearish channel. And then you can see the lower lows, right? You can see 97 over here, 79 here, 71 here. So we're in a locked in a bearish channel. So sometimes it gets exciting for the dollar because it moves higher, but it's just moving higher in a long bearish channel. So we believe we've hit the peak for this particular part of the channel, and now we're going to move over many, many, many months back to a new low below this 71.80. And in fact, that's kind of what we have here, this little range here. We expect the market of the dollar to come back down to its 2021 level, 2018 level, which is, 90 to 88, somewhere in there. And that ride, Dale, as it comes back down, that's going to be really good for assets. So
down it's faster.
So we're happy about that.
All right. Happy about the demise of the currency that we've been, it's going to make everything. Maybe that's the Fed's way of getting out of this debt trap, is just to trash the dollar. Makes it easier and have it be the sacrificial lamb. What do you think about CBDCs? Do you think they're going to happen?
Sure. Oh, sure. And we need to be impressed by that, because Bitcoin, didn't exist back in say 2007, whenever all the shenanigans were going on. It really didn't get released until, a year or two later. And so and so when you think about that, the central banks are old institutions. The Bank of England started back in the 1600s. I think we have a Bank of Sweden is even older or something like that. These central banks have been around for a while. They've been doing their business, and they move at a snail's pace. They're not like really big, fast innovators. So the fact that Bitcoin came out, they released a white paper, and now, less than 15 years later, these antiquated, slow-moving, Titanic type of institutions like central banks are talking about, hey, we need to take a cue from Bitcoin and actually use this kind of technology because it's that innovative, and let's do it now. So in other words, that's amazing that you would have a technology that comes out and within 2 decades would already not only be embraced by the central banks, but they're actually actively involved. You already have banks like China that already have their own digital currency. So I think the CBDCs are coming. I think they've kind of missed their opportunity to shut down Bitcoin. Now they just have to manage it. They're going to come probably after the hardware wallets. They're going to try to do other things, try to get our money into Bitcoin ETFs and away from the Bitcoin itself. There's a really important ratio we teach, the Bitcoin and S&P 500 index ratio. You just take those and just divide them. And this one right here, we were waiting for a cross of 7. That was the peak back in the 2017, 2018 area. And then we came down. This was kind of the bear market for Bitcoin. And then we came up and then we crossed 7. And that really led to a massive rally. We came down and held 7 and then did it again. And then we came down and then crossed 7. And then it became resistance through the whole thing. So we told our members, look, you get a nice big convincing breakout above 7 on this ratio chart, it's likely to confirm the next big bull market. Well, about 5 or 6 weeks ago, this happened, and you'll probably notice that was around the same time that you began to see Bitcoin really begin to break out. You began to see other cryptos as well really begin to move. So we're of the opinion that Bitcoin, which we've been in, Dale, not bragging, but just so your listeners and our members know, we've been in Bitcoin since 2012, 2013. We were very fortunate to learn about it early. We began teaching about it early. Many of our members bought Bitcoin when it was $200.
Nice.
Because they just said, I told everybody, hey, just go buy one, just go try it. Of course, going and buying one now is like, buying a car. It's difficult to do now, but back then it was easy. It was easy to buy the amount. It wasn't easy to procure. It was difficult to buy. But anyway, I'll make this.
So if we ended up closing back under 7, that would be a breakout failure, and you would get out.
I would start to question our thesis. I would say, maybe not yet, But as long as it stays above 7, I would say that's a very important number to watch, because that is historically. One last thing I'll talk about, because I know we're running out of time, but is the Bitcoin. Well, we use something called the extreme value zone. This has really, really helped me. When you talked earlier about how do you kind of overcome the noise, I use a chart like this to instruct my dollar cost average. I like to dollar cost average into high quality assets. And so what I use is an extreme value zone of 60 to 80% discount. Anytime a high quality asset is selling at a 60 to 80% discount from its previous all-time high, and I'm dollar cost averaging, I will double or triple my dollar cost average into that high quality asset while it's in that range. When it comes back out of that range, I'll just go back to my normal dollar cost. This allows me to buy more whenever things are low, when I think they're really high quality assets. So we have had a wonderful opportunity to add more Bitcoin. When Bitcoin hits a new all-time high of 69,000 or so, most people will then want to back up the truck. We would encourage people who have been buying Bitcoin now while it's been cheaper to think in terms of selling when it gets to a new all-time high, not to get sucked into the FOMO as soon as it hits a new all-time high, which is undoubtedly going to happen. So
it's not a profit till you take it.
That's so true.
So Jerry, how do people that saw this presentation and love your real nice technical work and interesting things that you use for market tells follow you and get involved with you?
The best thing to do would be to go to followthemoney.com, as you can see right here on your screen. And then right here, you can enter your name and email, and you can just join our free list. That's one of the first things you could do. We also have podcasts, so you can follow our podcasts. You can follow our YouTube channel. And we also have a Black Friday sale right now, 50% off everything, whether it's products, courses, memberships, whatever. So if they want to come and kick the tires and try it out, we'd love to have them. And at the very least, they can sign up for our free email and listen to our free podcast. But I always look forward to visiting with you, Dale. I appreciate your perspective and your experience. I respect that, and I appreciate you.
And back at you, Jerry, my trading warrior brother. You bring clarity every time you're here and conviction about what you're doing. I know you have skin in the game, and I'm always rooting for you, and hope you have a great trading season into year end, and let's get back together in the winter.
That sounds great, Dale. All right, buddy. Merry Christmas to you.
Jerry Robinson, everybody, check him out at FTM Daily on Twitter, and read his stuff. And I appreciate your time today, Jerry. Thank you, buddy.
Thank you so much.
Okay, and everyone else, you could join the team in 13 minutes on the Morning Edge. Remember, don't just count your pips, count your blessings. You're welcome, everyone. See you tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.